Waste management has long been considered one of America's highest quality businesses. A company known for resilient cash flow, consistent dividend growth, and a business model that has weathered almost every economic cycle. So why did Wall Street turn against it after the latest earnings report? Was the sell-off simply a reaction to slowing revenue growth? Or are investors beginning to question the company's long-term growth story? In this video, we'll separate short-term concerns from long-term value creation by examining both the bear case and the bull case, comparing Wall Street's concerns with management's long-term strategy, and asking one critical question. Is the market recognizing a real change in the business, or making the same short-term mistake that investors have made so many times before? For years, Waste Management has earned a reputation as one of the most reliable compounders in the market. It operates in an essential industry, generates predictable cash flow, and has consistently rewarded shareholders through dividends and disciplined capital allocation. That's why the market's reaction to its latest earnings surprised many investors. The business didn't suddenly collapse. Management didn't abandon its long-term strategy. So why did the stock decline? Did Wall Street identify a fundamental problem that the market had previously overlooked? Or is this another case where short-term concerns are overshadowing long-term value creation? To answer that question, we first need to understand exactly what the market was reacting to. At first glance, the market's reaction seemed straightforward. Waste Management delivered another profitable quarter. Earnings came in above expectations, margins remained resilient, and management reaffirmed its long-term strategy. Yet one number quickly became the market's primary focus. Revenue came in slightly below Wall Street's expectations. Under normal circumstances, a modest revenue miss might not be enough to trigger a meaningful sell-off. But when investors are paying a premium valuation for a high-quality compounder, expectations change. Every quarter becomes a test of whether the company's growth story is still accelerating, or beginning to slow. So the key question isn't whether Waste Management missed one revenue estimate. The real question is whether that revenue miss signals a temporary setback, or the beginning of a much bigger change. The market wasn't simply reacting to one disappointing revenue number. It was reacting to what that number might represent. For years, Waste Management has traded at a premium valuation because investors believed it could consistently deliver steady growth, strong pricing power, expanding margins, and reliable cash flow. But premium valuations come with premium expectations. The moment revenue growth begins to slow and collection volumes soften, investors naturally start asking whether the company's best growth years are already behind it. That doesn't mean the business is deteriorating. It means the market is becoming less willing to pay a premium unless management can prove that future growth remains intact. And that's exactly why the next question becomes even more important. Can pricing continue to offset weaker volume growth, or is this the first sign that the business is entering a more mature phase? For years, Waste Management has relied on a powerful combination: disciplined pricing and steady volume growth. When both are moving in the same direction, revenue expands, margins improve, and the business compounds almost effortlessly. But this quarter, that balance became less convincing. Pricing remained healthy, helping support profitability, yet collection volumes were noticeably softer, while parts of the recycling business also faced headwinds. That raises an important question for investors. Can pricing alone continue to drive long-term growth if volume growth remains under pressure? Or has the business entered a stage where raising prices becomes more difficult as underlying demand begins to normalize? These are the concerns currently weighing on market sentiment. But management believes investors may be looking at only one side of the story. Even as investors became more concerned about slowing growth, Waste Management continued moving in the opposite direction. Instead of pulling back, the company increased its investments. Capital spending remained elevated to expand renewable natural gas projects, modernize recycling infrastructure, and integrate the Stericycle acquisition. From the market's perspective, that's a legitimate concern. Higher investment only creates value if it generates higher returns in the years ahead. Otherwise, it simply puts more pressure on cash flow and raises execution risk. So Wall Street is asking a reasonable question. Are these investments creating tomorrow's growth, or are they becoming an expensive bet at a time when growth is already beginning to slow? Interestingly, management sees the situation very differently, and that's where the investment story starts to change. While Wall Street became increasingly focused on quarterly growth, management continued to emphasize something very different. The company's long-term strategy remains unchanged. Rather than maximizing short-term revenue, Waste Management is focused on strengthening the quality of its business through disciplined pricing, strategic capital allocation, and investments designed to generate higher returns over time. Management also reaffirmed its confidence in the company's long-term outlook, making it clear that current investments are intended to expand future cash flow, not simply increase near-term revenue. In other words, management isn't managing for the next quarter. It's managing for the next decade. That difference in time horizon may explain why the market and management are telling two very different stories. The question now is whether those long-term investments can become the next engine of growth. One of the clearest examples of management's long-term strategy is the acquisition of Stericycle. At first glance, many investors viewed the deal as an expensive acquisition that would increase integration risk and put additional pressure on near-term returns. But management sees something much bigger. Stericycle expands waste management beyond traditional waste collection into regulated healthcare solutions, a business with recurring demand, higher barriers to entry, and opportunities to deepen customer relationships. More importantly, it creates the potential for cross-selling across an existing customer base while diversifying future revenue streams. If management executes successfully, this acquisition won't simply make the company larger. It could fundamentally change where its future growth comes from. And that's only one part of a much broader transformation that Wall Street may still be underestimating. Perhaps the most overlooked part of waste management's long-term strategy isn't about collecting more waste, it's about creating more value from the waste it already collects. Every landfill naturally produces methane as organic waste decomposes. Instead of treating that methane as a byproduct, Waste Management is investing in renewable natural gas projects that capture, process, and sell it as a renewable source of energy. That changes the economics of the landfill itself. A landfill is no longer just a disposal asset. It becomes an energy-producing asset capable of generating recurring revenue from the same volume of waste. For management, this isn't simply an environmental initiative. It's a long-term capital allocation strategy designed to unlock higher returns from infrastructure the company already owns. And if that strategy continues to scale, today's investments could become tomorrow's competitive advantage. One assumption often drives the market's view of waste management. If waste volumes slow, future growth must slow as well. But management is building a different economic model. Instead of relying solely on collecting more waste, the company is focused on increasing the value created from every ton it already handles. That strategy includes expanding higher-value environmental services, monetizing landfill gas through renewable natural gas projects, improving recycling economics, and integrating healthcare solutions through Stericycle. In other words, future growth doesn't have to come only from higher volumes. It can also come from generating more revenue, stronger margins, and greater cash flow from the same underlying infrastructure. If that strategy succeeds, investors may eventually realize they were measuring waste management with the wrong yardstick. At the heart of this debate lies one fundamental question. What is the best way to value a business like waste management? For the market, the answer this quarter was clear. Revenue growth slowed, volume softened, and that was enough to raise concerns about the company's future growth trajectory. Management, however, appears to be measuring success differently. Its focus remains on expanding operating margins, generating stronger free cash flow, and investing capital into projects that can increase long-term returns. Neither perspective is necessarily wrong. The market is focused on the next few quarters. Management is focused on the next several years. Ultimately, the outcome will depend on whether today's investments translate into stronger cash flow and sustainable value creation over time. At this point, both sides have a credible argument. The bear case is straightforward. Revenue growth has slowed, collection volumes remain softer than investors expected, and the company is committing significant capital to projects that will take years to fully deliver returns. Those are legitimate concerns for a stock trading at a premium valuation. But the bull case is equally compelling. Management continues to execute a long-term strategy built around disciplined pricing, stronger cash flow, infrastructure expansion, renewable natural gas, and the integration of Stericycle to create new sources of recurring growth. So perhaps the real question isn't whether the market is right or wrong. It's whether today's valuation is being driven more by short-term uncertainty than by the long-term earning power of the business. The answer will become clearer only as those long-term investments begin to produce measurable results. The market has already delivered its verdict on this quarter. Investors reacted to slowing revenue growth, softer volume, and the risks that come with elevated investment spending. Those concerns are real, and they deserve careful attention. At the same time, management continues to execute a long-term strategy centered on disciplined capital allocation, higher value infrastructure, and new growth platforms designed to strengthen future cash flow. Whether those investments ultimately justify today's valuation remains an open question. And that's what makes this investment debate so interesting. Because in the end, the future of waste management will not be determined by a single quarter. It will be determined by whether today's investments create lasting value over the next decade. The market has made its judgment. Management continues to execute its strategy. Now the question belongs to investors. Will waste management's future be defined by one disappointing quarter, or by the long-term value of the business it is building? As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.